The energy sector has long sought to replicate the power of the stars here on Earth through nuclear fusion, the same process that powers the sun. This is a field that could fundamentally transform how we generate electricity. While most retail investors stay focused on big tech stocks or index funds, something unusual is quietly taking shape in the American market. A rather unique company is about to give everyday investors access to a real commercial nuclear fusion venture, an asset class that's been limited to private equity until now. In this video, we're looking at Spring Valley Acquisition Corp. 3, ticker SVAC, trading on NASDAQ around $10.46. Before we go further, this content is purely educational and does not constitute financial advice. Everyone needs to do their own research before making any investment decision. If you find this analysis helpful, consider liking the video and subscribing. Let's dive in. So, what exactly is SVAC? Here's where it gets interesting. SVAC isn't a traditional company with factories or employees manufacturing products. It's what's called a SPAC, a special purpose acquisition company. Think of it as a financial shell that raised money from investors specifically to find and merge with a private company, taking it public without the traditional IPO process. It's like a publicly traded blank check waiting to buy something real. And what's SVAC buying? A Canadian company called General Fusion that's building commercial fusion reactors, machines designed to create the same energy that powers the sun right here on Earth. If this deal closes, it would mark one of the first pure-play nuclear fusion companies hitting the public markets. Until now, this sector has been largely confined to government budgets and major research labs. Let's talk numbers in simple terms. Right now, SVAC has roughly $230 million sitting in a trust account, plus another $105 million committed by institutional investors. That's over $300 million in total capital that will be available to General Fusion after the merger closes. The combined company is expected to be valued at around $1 billion. This money isn't theoretical. It's real capital intended to fund the construction of these reactors, hire engineers, and scale the technology. The stock is trading at $10.46, just slightly above what's called the $10 redemption price. Technically, the SPAC structure includes a $10 redemption option before the merger, but this doesn't constitute a guaranteed protection of capital invested in the secondary market. The price you pay today on the open market could be above or below the redemption value, and market conditions determine what happens to your investment. This mechanism only exists until the merger closes, likely around mid-2026, after which it disappears entirely and the stock trades like any other public company. So why is this happening now? On January 22nd, the merger was first announced. The stock has held above its redemption value, reflecting current market interest in this deal. Let's put this in context. We're living through a massive energy transition. Governments worldwide are pouring billions into clean energy because fossil fuels are finite, solar and wind have intermittency constraints, and traditional nuclear plants create radioactive waste. Fusion energy could theoretically solve all these problems. Unlimited fuel, zero emissions, no hazardous waste. The challenge has always been making it work commercially, not just in a lab. General Fusion has been working on this for years, and now they're ready to go public with real capital to build actual power plants. That's the backdrop, an opportunity to track a technology that could reshape global energy markets. But let's be honest about the risks, because they're significant. First, the technology isn't proven at commercial scale. General Fusion may not be able to deliver reactors that work profitably. Second, execution takes time. We're talking years, possibly a decade, before this becomes a revenue-generating business. This is a high-risk bet on cutting-edge science, and that means it's only appropriate for people who understand they could lose their entire investment. So, what's the bottom line? SVAC is a vehicle bringing a commercial fusion company to the public markets. It has real capital, institutional backing, and a clear timeline. The merger is expected to close by mid-2026. The technology is ambitious but unproven. The risks are real, and the potential is worth watching. This is not financial advice. I'm not telling you to buy or sell anything. What I'm saying is this. If you're interested in the future of energy and investing in early-stage frontier technology, this is worth understanding. Not because it's guaranteed to succeed, but because understanding how these opportunities work makes you a better investor. Do your own research. Read the filings. Understand what you're getting into. If you found this analysis helpful, consider liking and subscribing for more educational content like this. Thanks for watching.